A warm welcome to you and many thanks for joining me once again on the program. I am Folashade Ogurinde. When the United States of America, the largest economy in the world, announced an increase in its interest rate, economic experts in Nigeria predicted that other economies, and Nigeria included, would do the same. But what they did not see is an increase of interest rate to as high as 13%, as announced by the governor of the Central Bank of Nigeria, CBN, on Tuesday at the end of the Monetary Policy Committee meeting. Godwin Emefiele, in his briefing, explained that the major determinant for the increase in interest rate was the need to curb inflationary pressure. But is this the right move for the Nigerian economy? To make sense of this, Gospel Obele, Chief Economist at Streetnomics Limited, joins us now on the program. Many thanks for joining us. Now, the IMF urged central banks across the globe to raise interest rates in order to halt escalating inflationary trends. But we've obviously seen this implemented across several economies in the world. What do you make of this?
Well, it's a very, very tough season globally. So it's very right to set the context. It's a tough season globally, and a lot of economies are looking for ways to adapt, to adapt to these critical changes. And let's not forget that the factors that are influencing prices, as well as influencing for interest rate adjustments, are largely geopolitical. Those factors are largely based on the COVID-19 pandemic, as well as all the supply chain disruptions coming from the pandemic also. And let's also have in mind that for countries like Nigeria, we sit at the base of the value chain in terms of anytime all of these global shocks hit, all right, it affects economies at the base more severely. So when we see nations at the top or advanced or high-end emerging market economies adjusting accordingly, it's likely you see that economies at the base will want to follow suit as well. But what we also have in mind is what we also think of is the need to harness critical efforts across all of the factors and variables that would help countries like Nigeria navigate this tough season we are in now, aside just the interest rate as a tool. And so for me, that's the call for worry. And that's why I think we need to begin to look at if we need to make a very sustainable headway from this moment.
So for Nigeria now, do you see the decision to tighten as the best course of action?
Well, the best course of action now is really relative. It's relative on many grounds because, number one, where we are right now on the global rung of the ladder, the global rung of the ladder. Another conversation also is where does Nigeria stand in terms of global competitiveness and vulnerability to shocks? Of course, we know that we're really, really vulnerable. On the third block of things is the fact that if we're aware of the complexities, well, I think that the central bank is actually aware of the complexities we're currently dealing with. But then again, it's a trade-off, right? It's a trade-off of if you want to control inflation or empower growth, as it were. And the central bank chose to control inflation by increasing the interest rates. There are fears that may backfire. Is it the best of decision right now? Again, it's still relative because it's a trade-off. So you choose one out of a trade-off that you think is of a higher priority right now to the economy, and the central bank chose to curb inflation by increasing interest rates. And the idea, the catch is when you increase interest rates, people are discouraged to borrow, and then the assumption is that it reduces credits available to the economy. My own fear of that logic is the fact that that may also sort of like backfire, because when the industrialized sector or the real sector cannot access credit or finance, or if the cost of accessing credit or finance is higher than it used to be, it may slow down economic activities, which may, number one, either come back to hamper on the growth you're trying to protect in the first place, or it may lead to some form of increased prices, because then again, with scarcity and uncertainty comes increase in prices, and that brings us back again to inflationary question. So it's still a developing conversation. We're trying to see how this will play out, but my big fear is this: interest rate as a single policy is not enough or sufficient, to deal with the complexities of what the Nigerian economy is dealing with right now. Especially when you think of the trade-off economics between GDP growth and inflation.
Now, stakeholders in the manufacturing sector have decried this move. Do you agree?
Yeah, of course, I expect them to, because the manufacturing sector is a real sector. That's the bane, that's the core when you think of industrialization, that's the core when you think of economic activities driver and potential productivity driver as well. All right, your manufacturing base is a base for competitiveness in the first place, no matter where you are on the spectrum of competitiveness to start with. So I expect them to kick back, which is what has happened, because it means that the cost of borrowing for them will be higher. It means that interest expense will be higher for the manufacturing sector and players in that space. It also means that it has a potential access to finance within this context may frustrate efficient production capacities, or being able to participate effectively in economic activity. So these are the worries for the manufacturing space, and that may lead to a lot of reshuffling in the coming months if we do not see the necessary progress or improvements, as it were. And again, knowing fully well that we're in a pre-election season, that also breeds a lot of uncertainty, all right, within the context of economic activities and how money will be supplied into the economy. And we get to see at the end of the day that it may not necessarily have been an interest rate conversation, but there are many much more variables outside the monetary policy economics that are influencing what we have right now. And that's the big fear.
Now, before I let you go, in real terms now, what does higher interest rates mean for the average Nigerian?
So it's very simple. High interest rate simply means that for the average Nigerian who's an investor, he gets to earn more actually, because it means that your interest income will be higher. For banks and those who trade in markets, the interest income will be higher. But technically, these are not the average Nigerian in quote, and all that. The average Nigerians are those who borrow these monies for their businesses, those who are on the manufacturing space, those who live lives on a daily basis, and those who take the effect or the final impact of these things. And what is likely to happen is that it may sort of come back to hurt the economy, because it means that borrowing is going to be much more expensive, and it's going to hamper on the productive on the real sector. When it hampers on the real sector, prices may go up because people will begin to control for either scarcity or the fear of scarcity or the fear of uncertainty. When you also contextualize these things within the electionary period that we are in now. So that may increase prices, and the average Nigerian may not necessarily be better for it in the mid to long term. Also, not forgetting that the economics of pre-elections in itself, outside this whole interest rate argument, would bring uncertainties that will pressure on the average Nigerian. So, fingers crossed, we're actually watching how the whole event will unfold in the coming months. But I really hope that the effect won't hit hard on the average Nigerian, because if it does, it's really going to be a catastrophe.
Well, indeed, Gospel Obele, Chief Economist, CEO at
Thank you for
Streetnomics
having me.
Limited. Thank you very much for your time.
Thank you.
Well, we'll take a breather here and be back shortly. To stay with us. Welcome back. The Securities and Exchange Commission (SEC) has published a set of regulations for digital assets, signaling Africa's most populous country is trying to find a middle ground between an outright ban on crypto assets and their unregulated use. Nigeria's central bank last year banned banks and financial institutions from dealing in or facilitating transactions in cryptocurrencies. But the country's young tech-savvy population has adapted using peer-to-peer trading offered by crypto exchanges to avoid the financial sector ban. But with the Central Bank of Nigeria's silent on SEC's new regulation, market players and cryptocurrency enthusiasts are left in the lurch. To discuss this further, personal finance expert Kalu Aja joins me now. Thank you very much for joining us. Now, What do you make of the Security and Exchange Commission's new rule on issuance, offering platforms and custody of digital assets? Does it give the industry a legal stature?
I think it's very welcome because what it does is it provides a framework and a pathway that Nigeria can, or Nigerian issuers and, should we say, startup entrepreneurs can then work with SEC to basically issue these coins or create an exchange. SEC has issued this, should we say, exposure guidelines, and normally you will take them, review them, you can go back to SEC as it were, but SEC is saying that they recognize that this sector is a growing sector, hence it must be regulated so that the investors, the general investing public, can then be able to find out who is regulated, who is legal, and who they can transact with. So overall, it's a wonderful development for the industry. It can only lead to good. And I'm saying this in contrast to the other directive we've got from the Central Bank of Nigeria that is asking banks not to deal in this sector. So in this instance, the Securities and Exchange Commission is actually doing the best thing in issuing these guidelines, because then it then guides the players in the sector on how to get regulated and legal.
Now, for digital assets offering platforms looking to operate in the market, SEC requires a minimum paid-up capital and fidelity bond of 500 million naira only. What do you make of this?
Yeah, great question. So I think SEC is setting this minimum capital of 500 million at a very, very high bar so that only quote unquote serious players that have the capacity and the funds and the capital to get into this business can basically come to SEC to seek registration. Remember, cryptocurrencies, it's a very, very new industry. It's being used by a lot of people, but it's still new. Even in the US, there are like different regulators that regulate cryptocurrencies. The IRS treats it as an asset. The Commodities Exchange also regulates it. So there's not one single regulator. So SEC is essentially trying to set a very, very high bar. So if you want to then be a legal, purveyor of digital assets, you have to basically have this minimum to show that you're a serious player with serious partners and I can do this. Keep in mind this week, or was it last week, we saw the crash of a stable coin, the UST and Luna. And that's all liquidity driven. You had an exchange that had a quote stable coin that is now basically worthless, right? Because they had issues with liquidity and how they are, so we say, supporting that stable coin. So in my personal opinion, 500 million is not, it should be a lot higher than 500 million. 500 million is give or take about $1 million. It should be much, much higher than this 500 million to ensure that all those players that do not have this capital maybe come together and form one consortium or go get a technical partner or go raise capital. The investors have got to be confident that whoever is offering an exchange or is going to be SEC regulated has the capacity and funds to do this business. So in my personal view, this should even go higher than $500 million naira.
Now, it's been a while since SEC gave this new directive, but the Central Bank of Nigeria has remained silent on the matter. What does this signify for digital asset operators, and what do you think would be the CBN's next line of action?
Well, honestly, I don't think they will change their circular. Remember when they first brought out their own circular asking banks and individuals, or banks not to deal with cryptocurrencies? SEC actually aligned with them, right? And I know some folks took them to court, and I heard the judge say something like there is no law prohibiting cryptocurrencies in Nigeria, that the secular is not a law. So there is really in Nigeria no law per se saying a bank cannot deal with cryptocurrencies. It's just the CBN, which is the regulator of the banks, asking the banks not to deal in this. So if SEC has come out and defined what a cryptocurrency is, that is a security, and then is going to issue licenses, it then means that if Nigerian banks cannot offer this service, then the CBN is basically taking them out of the picture. If SEC has this is okay, why aren't the banks, Nigerian banks, doing it? That means a Nigerian exchange could go to a bank in Cote d'Ivoire or in Benin Republic and legally open a banking license and the business would flow there. So personally, I do not think CBN will change. I hope I am wrong. And then they will then toe the route of regulating rather than an outright ban or secular asking the banks not to deal with this. That's my personal hope. But my fingers I'm not holding my breath here.
Now, the U.S. Securities and Exchange Commission raised concern and cautioned about investing in cryptocurrencies, explaining that the digital asset class is not that decentralized. What do you think about this?
Yeah, I mean, it's not just the US. All the central banks in the world, literally all of them, don't like digital currencies, cryptocurrencies, all of them. The UK, the US, the EU, they've all spoken out against cryptocurrencies. The problem is that the whole idea of a cryptocurrency is this idea of you can't simply print it, and the central banks can print money. So inflation is a problem. So if the users want cryptocurrencies, it's very, very difficult for the regulators to say you can't have it. So what you even see in the same US is that the President Biden passed an executive order asking the SEC or the regulators to come up with a regulation of how cryptocurrencies will then come under the regulatory ambit in the United States. So they are pursuing an e-dollar. They have an executive order asking them to pursue that regulation as well. And I know that they are doing a lot of stuff behind the scenes too. They want to sort of regulate it and to offer an option that is not a private cryptocurrency, but a cryptocurrency issued by the US government or by the Fed in which they have the control over. So it's really a question of control. Imagine if everyone stopped using the dollar and started to use Bitcoin. Then, of course, the US Fed would have to spend more to borrow. So no one likes that. And same thing with Nigeria and the European Central Bank. So that's why you see this issuance of central bank-backed digital currencies from China, even to Nigeria, even to the EU. So it's a power play going on, right? They all want the benefits of it, but they don't want to lose the advantage of being able to issue currencies. So there'll be a middle ground somewhere with regulation, with central bank-backed digital currencies. That's where we're going to basically end up in the end, I believe.
Now, personal finance expert Kalu Aja, thank you very much for your time on the program.
You're very welcome.
Well, it's a wrap on Money Matters. See you again next time. I am Folashade Ogurinde. Bye for now.